Hello traders, hello everyone. Welcome to the advanced room here at Life Education with XM, and welcome also viewers from other platforms, YouTube, Facebook, Telegram, and of course XM Live Education website. Hello Marius. I'm here with Marius to discuss the fundamental background for traders, about markets, about what's happening and what's next. It seems a crucial moment and crucial question. What's next after March banking turmoil? A little bit of markets comeback. Well, we are looking into next week as well, but before next week happens, we have one more thing to do, one more thing to discuss and to observe. Non-farm payrolls. Hello, Marius. How's the mood?
Hello, sir. It's been a busy week. We've had some very significant moves in the markets. We're gonna discuss all of that. It has to do with speculation about the Fed cutting rates and all of that. The economy slowing down. Everybody's, not panicking, but well, we've seen gold go to new highs. A lot to discuss there. But of course, we have non-farm payrolls. That's going to affect everything. And it's a special non-farm payrolls episode because it's Good Friday, obviously, in a lot of countries, and that means a lot of markets are closed. That means we don't really have a lot of liquidity in the markets. A lot of people are missing, a lot of traders are missing from their desks, and that means that when we do get the data, that can amplify the impact. We are likely to see larger than usual moves following the NFP data. Hopefully, right? Nobody can. But how has your week been? How are the market gods treating you?
Well, the market gods have been, quite all right. I mean, uh, we are in this moment of relieving and calming down, right? If we look, for example, at VIX, it's just back to 20, and it feels so by the market action. We are seeing a little bit of movement in commodities. However, though I'm not very much involved in commodities at the same time. But so far so good. It looks like everything calming down, and I'm losing this channel focus, and starting again to look at bigger picture and having questions, more like about future, like what it's gonna be. Of course, non-farm payrolls today, and as you said, it's not very liquid market, so a little bit tricky, to be on the market right now when this non-farm payrolls report comes. But it's also very interesting to be observing, I think, because first of all, so we have central banks, and there is a little bit shift in central banks narrative. We had yesterday jobless claims. We had jolts on Tuesday, which were also sort of, I don't want to use the word surprising, right? But they were disappointing in a sense that not so great, but at the same time they meet expectation of many people who are basically looking for unemployment to rise and for Fed to pivot. Let's not lie to ourselves. It's all about Fed pivot.
Of course.
Everybody waiting for it. So
It always is.
so there is interesting dynamics in all of this, right? Because I think that what central bankers are saying is actually hawkish shift. Maybe it's subtle, and because it's big picture, it's not like immediate. But I think the rhetorics became more hawkish actually, and then we are having people looking at non-farm payrolls today, especially attentive to non-farm payrolls today because of jolts and because of yesterday's jobless claims. But at the same time, those are different periods, right? Like different, we will see non-farm payrolls data and labor data today from different period than we've been seeing um, those those um, those releases that
Mhm.
missed expectations earlier this week. What do
Before
you
we
think
go on,
about that?
before we go any further, let me welcome Jamal and Lion to the chat. Welcome everybody. Hi, Marcio and Marios. And Lion is saying, at what time is NFP? NFP is in 24 minutes, Lion. Now, to go back to what Marcin was saying, and of course, guys, please continue, ask us anything. We are here to answer anything and everything you might have. So to summarize, what Marcin was saying, we got some pretty bad data this week from the United States specifically. So we started the week with a disappointing manufacturing survey, and everybody said, you know what? Okay, it's manufacturing, it's 10% of the economy. We knew it was in trouble already. Maybe it's not a disaster. Then on Tuesday, we got disappointing data on job openings. So that means the how many job listings, how many open job positions there are in the United States, that number fell by 1 million from January to February, which is a big drop. And suddenly the market is saying, oh, you know what, maybe the labor market is slowing down. Maybe all of these rate increases have finally started to impact the economy. And we got a confirmation of that on Wednesday when we got the non manufacturing ISM survey, which was really disappointing. New orders were down. That's bad news for economic growth. And, employment fell. It was a bad sort of data week. And of course, like Marcin mentioned, on yesterday we got initial jobless claims. That's the number that shows how many people applied for unemployment benefits over the last month. And that rose as well, which is also a worrisome signal. So we've gotten a lot of signs that the jobs market, especially in the US, is starting to lose momentum, and that's what makes this jobs report even more important, right? And I'll the final point I'll make here, as we speak, Marcin, the market is pricing in well, the market is pricing in the prospect of another Fed rate increase next month as a coin toss. It's essentially a 50-50 probability whether the Fed will raise interest rates one final time or whether they'll stop in May. So the market is looking at the whole situation and saying, yeah, we're not really sure whether they raise interest rates again. And that also, puts even more emphasis on the jobs data because it's going to help the market decide whether that's going to happen.
Well, there is clear problem, right? Because those readings yesterday, continuing jobless claims and initial jobless claims, they both are bad in a sense. Like you may say, okay, from 200 to 228,000 initial jobless claims, it's not that big of a deal. But the problem is that continuous jobless claims, they were low, they were lower and staying flat, and now they jumped up, meaning that people who initially claimed jobless benefits previous month, they are not finding new jobs so easily
Exactly.
right now, right? So
Mhm.
actually the pool of jobless people is growing at the moment. And also we had revisions which were also pretty bad. Like I mean everybody took good data for granted, and out of a sudden it turned out that for example initial jobless claims weekly initial jobless claims had been revised by 50,000. So it's
Yeah,
like 25%
big jump,
revision uh,
huge
to,
jump.
to the wars, right? And also we had 130,000, so it's like 8% or something like that. Quick math live, 8% or something. Also to worse in terms of continuing jobless claims. So it's it's not a great picture, and we still see inflation being high. So what's tricky about this situation? We are seeing that certain components of inflation are quite sticky, and central bank has started pointing to that. So that change in rhetorics I've mentioned is about saying that probably fight with inflation will take longer than initially expected or previously expected, and that um, so it might mean that it will require also more hawkish stance from central banks, which is in contrast to conclusions from the labor market, and you also mentioned earlier PMIs, which
Mhm.
also pointing in the
Direction.
direction of recession, and actually that's the case that doves are making for central banks to pivot, right? So
Mhm.
they basically say well, Fed will have to pivot because of economy going in a wrong way, in a bad way, and unemployment rising. But at the same time, what do we do if inflation stays sticky, so to speak? And especially, central bankers are pointing out to core inflation recently, and which remains high and is more stubborn, I would say, and rising unemployment. Like this is something we don't want. We wanted to have low unemployment, sorry, and inflation coming down. And initially, like 2 months ago, everybody thought, okay, that's happening, right? That's possible. Right now, it feels like inflation became stubborn, and jobs market is more of a concern right now, which is very negative scenario potentially,
I was
and
gonna make
it's a dilemma, right?
I was gonna make a joke. I want to eat ice cream every day, but it's not really, it's not really advisable either. So what the central bankers want and what the central bankers will get is a different thing. So we talked about the signs that the US labor market is weakening. Of course, we're going to get the jobs data in 15 minutes, and we're going to cover what the markets expect very in a moment. We also mentioned the business surveys as pointing in the direction of a recession being not imminent, maybe, but on the horizon. I've got one even better sign. So a few months ago, I can't remember if it was 6 months ago or 8 months ago, but during a press conference, Fed press conference, Chairman Powell said at some point, they were asking him about the yield curve, the journalists, and they were basically saying, you know what, like the bond traders are betting that there's probably going to be a recession in the US, that the difference between 10-year bond yields and 2-year bond yields, that has inverted. Usually that's a recession signal. Are you concerned? And Powell basically replied, no, no, we are not really concerned because our econometric models and our research suggests that this is not the metric that really forecasts a recession. And he said that the metric we look at is the difference between the 3-month yield versus what the market thinks the 3-month yield will be in 18 months. So the 18-month forward 3-month yield. This sounds complicated, but it's just contracts that are traded. Hear me out though. And Paul was saying back then that curve is not inverted, so we are not really concerned about the recession. That curve, I can send you a picture of it. It has inverted dramatically, and it's still going lower. So it started inverting in November, and usually once it inverts, a recession follows from 5, depending on the cycle, but 5 to 15 months later is where you would expect to get a recession. And we are right at the 5-month point right now. So is
Marius,
this time different?
but
Yes,
if we
please.
if we talk about central bank officials and government officials, it's always like recession is not in forecasts until it is in forecasts, right? So
Mhm.
they
Yeah.
never admitted they couldn't actually. Well, there is some sense in it, but I don't want to go into digression too much. Um, by the way, I want to welcome Whooper Goldstein from YouTube. Hello, and thank you for the comment. In a moment, we will have to end the streaming on other platforms, but you can all join us on xm.com live education on XM website. The webinar will continue. We will continue discussion and also, of course, answering your questions. Thank you for all the questions you are sending to us. For example, Joseph Mwabilwa, hello, thank you for your question, Joseph. Does Thursday unemployment claim affect the NFP? I think this is.
Yes, it does.
Mhm.
Yes, it does. And it's very funny that it does because usually, um, okay, here's a secret not many people know. When you get the jobs report that we're going to get in 15 minutes, that data for that jobs report was collected during the second week of March in this case, right? So what you look at to try and determine whether you're going to see weakness in the jobs report is initial jobless claims from that week, so 2 weeks ago, essentially. Now, so usually when you get jobless claims the day before NFP, it doesn't really affect NFP, but this time you had major revisions to those jobless claims higher.
Yes.
So last week, when we were previewing the upcoming week, I was saying unemployment claims remained very low. That means not a lot of people are applying for unemployment benefits. That means the jobs market is still strong. But suddenly we got the huge revision, and then we also got the weaker business surveys, and suddenly it's not so clear whether it will be a strong NFP report or not. In fact, most signs suggest it's going to be a relatively weak report. Of course, we can go into detail if you want, but we can also go through some other comments in the chat.